Hello out there, dividend growth stock enthusiast. It is Colby, the DGI Crab. Sometimes you guys present me with excellent questions that require, in my estimation, a video response going into further detail about how I feel about the overall question and the best approach to take moving forward with not only giving a good answer, but also hopefully providing you all with some context to maybe make all of us better dividend growth stock investors. That's really what it's all about. So the question that I got here is actually just in regards to the thesis of the channel in the first place and how I feel about the long-term impacts of the key metric here, the the growth in DGI. Because obviously we can always go with really high yielding stuff that doesn't really grow very much year over year over year, but how do you guarantee yourself better growth? So here's the question that the viewer presented here down in the comments of a previous video. He says, I love the channel. The question on the thesis of the channel is strategy. Stocks trading well below their average dividend yield, i.e. buy zone, may have business headwinds that long-term reduce the dividend growth rate below the target range. The average dividend growth rate continuing long-term seems to be an extremely important assumption, and I wonder if it warrants further testing when making buy decisions. Any thoughts? Well, plenty of thoughts to share here, viewer, and I'm just going to go over how I formulated my lists, my strategy, and how to deal with what you present here is a very fair question where there are sometimes when you're talking about individual single stocks that a company does go through it and they have tough quarters or maybe even a tough stretch of a couple of years where maybe at one point they were growing their dividend year over year well above 10%, and then they have a slow year and they do like a 1 or a 2% increase, and maybe that lasts for years and years into the future. Well, there could always be places to reevaluate where a stock should fit in the overall grand scheme of things, but I'm just going to kind of go over this here a little bit. So just in case anyone isn't aware, my personal strategy here is I do 50% of my money every week goes into age-appropriate ETFs. I'm considering age and time horizon to be the key metric when deciding what dividend growth stocks to purchase, meaning if the younger that you are, you don't chase high yield, you're looking for really high year over year dividend growth. You've got a lot of time in the market, so you need to take advantage of that time by buying stuff that's going to grow 10% or better year over year as opposed to high yield stuff right now. The high yield stuff right now is what you probably want to be looking at once you get up into your 50s and 60s, and you're just trying to add stuff that's going to generate you higher income immediately, because you're not going to have as many decades left in the market as somebody that's 22, 25, even 35 for that matter. Now, my buy zone personally, I'm generally looking for single stocks that are yielding 30% or more above the 4-year average yield. And I only am focused in on a total of 60 stocks. Now, those have been split into 4 separate categories or tiers based on your age and your time horizon. So let's go back into the DGI Crab portfolio spreadsheet here, and we're going to just kind of take a look at this by the tiers. As I said, the tier 1 category, this is your 18 to 30-year-old investors, and I'm going to start on this tab here because this is where the long-term dividend growth that my viewer asked me about is really going to be a major decision and something to take into consideration here. So if you're only purchasing 2 or 3 or maybe even 5 individual company stocks, and that's where the primary emphasis of your dividend income is going to come from, then if let's just say 5, you've got 5 companies that you're going to really focus in on. You're going to pair that with an ETF or 2, and that's your strategy. And that's a nice, clean portfolio. It's very easy to keep track of. The issue is with if you're only looking at 5 individual companies, If one of those individual companies goes through a tough stretch for a prolonged period of time, then that can definitely have a very major impact on your growth projections in terms of the dividend income moving forward. Now, if you look at this group of stocks here, I picked these because they have long track records of not only increasing their dividends year over year, but doing so at a very rapid pace. Most of these are generally going to do 10% or better annual increases more often than not. But there's more than 5 of them here, as of course you're well aware. We've got 16 total here in the group. Now, if you're just starting out, I don't think it's a great idea to just run out and start purchasing all 16. You want to emphasize things when they look like they're trading for a discount. And my metric, of course, is comparing the 4-year average yield to the current day yield. And I'm looking for that 30% or better discount, if you will, on that dividend income. Now, if we look at the 2024 dividend increases that were dished out for these 16 stocks, we'll see here that on average, if you had just an average, just an exact amount of all 16 of these, you would have gotten an 11% raise to your dividend income from these single stocks, which is great. 30 and under, I mean, it's great for any age, but especially 30 and under. We want to get that well above 10%, and we got that last year at 11%. And last year was kind of a down year for dividend increases across the board in a lot of regards. But if we look at some of these here, we can see that not all of them came through. SPGI, S&P Global, they just did a 1.1% dividend increase. Lowe's Company, one of my very favorite dividend growth stocks. I mean, this one came very close to making my personal top 10 list. They have such a great track record of dividend increases year over year, double-digit dividend increases. But last year, blame it on inflation, blame it on presidential election, whatever you want to blame it on. Lowe's just didn't come through with the dividend increase that they typically do more often than not. We just got a 4.65% increase. But paired with enough of the other ones that did comfortably top that double digits, like Sherwin-Williams with 18%, Aflac with 19%, it makes up for some of the ones that did a little bit less than what we are used to give us a nice moving average here. But if S&P, if SPGI was 20% of your portfolio and you got just a 1% dividend increase, that's going to give you kind of a down year because of the overall weighting of it. But this is why, in my opinion, you want to have a decent amount of stocks, of individual holdings, so that way almost certainly one of them every year, once you get to the point where you've got between, let's say, 10 and 30 holdings, you're going to have at least one that gives you a very disappointing dividend increase. And hopefully you've got 3 or 4 that give you not only what you expect, but well better than what you expect, and it sort of weights things out. If we look at tier 2, this is the largest tier on the channel. It's 19 total stocks. It's for the 31 to 41-year-old investor. I want to see 7 to 9% annual dividend growth on any of these individually. But again, they're not all going to do that like clockwork each and every year. You're going to have some that far exceed expectations, like Hershey gave us just shy of 23% increase in 2024, but Target was just 1.83. The average across the board on these was 7.61%, which is a little less than what I'd like to see out of this group, admittedly. But still, though, spread out across the board, pretty nice dividend increase, especially when you're buying things at a starting yield of 3% or better. So again, if you've only got 4 or 5 or so individual single stock holdings, it definitely is less to track. It's a cleaner portfolio overall, but just be prepared that if you don't have that diversification amongst the individual holdings as a dividend growth stock investor, then you might have some years where you don't get the kind of raises that you were typically going to expect. The same idea for the other tiers, tier 3, 42 to 53 years old. I like to see like 5 or 6% out of this group year over year. And that's what we got out of most of them. But we've got an 11% increase from ADM in 2024, which was great. We got a 0.47% increase from American Tower, which is way off what American Tower typically does, but it was a hard year last year for real estate investment trusts, so they just didn't give us the kind of increase that we could come to expect. So when I was putting the tiers together and kind of trying to decide, what is the right allocation, let's just say, to have, and how did certain things get into each tiers? Let's start here with a tier 1 stock, Microsoft Corporation. So this was my thought process sort of going into all of these. I really went in and looked at the dividend history and the dividend growth on Seeking Alpha. I checked both of these very carefully. But if you go to the dividend growth, you can see what they've done over the years. And the annual payout growth year over year on Microsoft, you can see, is very, very consistently around 10%. Sometimes it's a little more, sometimes it's a little less, but Microsoft is a very consistent one. And what I wanted was double-digit dividend growth for that tier 1 category for the 18 to 30-year-old investor. And Microsoft obviously seemed like it was best to go into that tier 1 bucket. Now, if we look at one like, I'm going to go to Target here next from that tier 2 category, because they were a stock that gave us a very low dividend increase last year. And because their share price is trading down, I'm not expecting them to give me a good, solid tier 2 level dividend increase this year either. So I'd be very surprised if I got 6, 7, 8, 9% dividend increase from my Target position this year. Now, what you have to keep in mind is if you are buying Target like me right now, you're buying it at a yield well above 4.5%, whereas the 4-year average yield is 2.5%. So you're already making up a couple of percentage points just on the purchase price when you're buying something that's down. But if you're not expecting the share price necessarily to come back, or the dividend growth to come back right away, you do sort of have to hold your breath a little bit and hope that the company can pull themselves up out of the dumps. It's like with the case with Target. You can see here, bad increase in 24, banger increases though in 23, 22, 21. And then in 2020, 19, and 18, kind of bad increases in the 3% range. But if you keep going back through it, you can see more than a decade of double-digit dividend increases well above that. So at any given time, you could look at Target and think that it might be a tier 1 stock. Maybe it's a tier 2 stock. Maybe in some years it even looks more like a tier 3 stock. But I do think that overall, if you sort of average those numbers out, you'll see why I wanted to put it in that tier 2 category. Because while I'm very likely not going to receive year over year an exact 10 or an 11% 5-year growth rate on the dividend, some years it's going to be 1%, some years it might be 20%. But again, that is why I like to have a nice basket of stocks in each individual tier. So if I get a bad year out of Target, hopefully that's going to be balanced out with a great year by Aflac or Hershey or whichever one happens to be doing better on that particular dividend growth metric. And then finally, as you can see here with Target, they've increased the dividend for 56 consecutive years. So they've been doing dividend increases through all of the major stock market crashes that we have seen longer than I've been alive, longer than probably a lot of you have been alive. They've come through bad times before. Sometimes they increase their dividend a little less than others, but they are giving us increases nonetheless. And that's the thing that these 60 stocks have in common. Very long track records. They've been tested by multiple recessions, multiple crashes, and I think that they're all going to come out on top. And if any of them cut their dividend, I will actually sell out of them and move that money into something else. Pair that with ETFs, you've got automatic diversification, and I don't think you can go wrong with that.